Okay, awesome. Welcome everyone to the webinar today. The topic for our discussion is learn to read the chart. So we will take a look at Japanese candlesticks. Those are the charts that we look at, and we'll look at how do we understand the candlesticks, what are the different patterns. So what are the different patterns that we are going to look at that we can trade, and what do these candlesticks tell us about the market direction? Okay, so my name is Raman Gill. I am the founder of the website tradingwithvenus.com. In this live training, like I said, we'll look at the basics of candlestick charts. We'll look at candlestick patterns. We'll learn how to identify the candlestick patterns to take trades. And then we will look at where to enter and exit a trade based on candlestick patterns. And of course, the last step, which is the most important step, is how to properly implement this strategy and make money. Just a quick disclaimer before we get started. This is for education purposes only. Trading is risky business, so make sure you understand the trading well. Make sure you understand what you're doing before you risk too much money into it. I always recommend that when you're a beginner trader, try demo trading. You know what? You get the practice, and you don't have to worry about taking any risk on. So do that. Okay, just a little bit about me for those who don't know me. I am a Forex trader. I've been trading live for about, well, more than 7 years now. I have an MBA from the US and Canada here. I used to be in IT before, so I've made the switch from IT to trading, and that was it was a nice career change. So this is what I do today. I'm also a mom and wife, so this is a good provides me flexibility in my life. So this is a good career for me. All right, so that's me. So let's just dive into it now. So first thing that we will take a look at is, this may be a little basic for a lot of you guys, but just bear with me. We'll get into the more of the advanced stuff in just a bit. So first thing that we want to understand here are Japanese candlesticks, because the charts that we use are called candlestick charts. So a lot of times when you're trading stocks and other things like that, bar charts used to be the chart of choice. However, Japanese candlesticks have been very, very helpful for most traders in how to read the price. So most Forex traders will use Japanese candlesticks. So that's what we'll take a look at. So it'll be the candlestick charts. So understanding the candlesticks first here. So we have bullish candlesticks. These here are the bullish candlesticks. So in a bullish candlestick, we have the price that opens at the bottom, and then price closes higher. So it opens low, closes higher, and at some point while this candle was being formed, price went all the way up to the top here, which is the high of the candle. And at another point, the price was at the bottom here, which is the low price of the candle. So that's how we get the candlestick. So this is the open price, close price, this is the body of the candle, then we have wicks on either side. So the size of the wicks can differ. However, we may have wick on one side or both sides. So these are called the wicks, and they just represent where the price was at some point in the candle. When the price opens low and closes high, it's called the bullish candlestick. And bearish candlestick is when the price opens high and closes low. And then in the middle, you have the body of the candlesticks. And again, you have wicks on both or either side here. And this is the price, this is the high of the candle. At one point, this candlestick looked green. It looked like the price was going to go up, but it pulled back, and then sellers were in control and pushed the price down all the way to the low at one point. So it was a big red candle. However, the price got pushed up again, and this is where it closed. So this is called bearish candlestick. So we have bullish candlesticks that open low, closes high, bearish candlesticks that open high and closes low. So this this is just the intro. So we'll be getting more into the different candlestick patterns. Okay, so some of the patterns that we'll take a look at today will be spinning tops. We'll take a look at hammer and, actually we won't look at hanging man. We'll take a look at hammer and shooting star. We'll take a look at engulfing candles, bullish and bearish engulfing candles. And then we'll also take a look at tweezer bottoms and tweezer tops. Okay, so let's dive into this. The first pattern that we'll take a look at are called the spinning tops. So this here, the white one, is a bullish spinning top, and this is a bearish spinning top. However, it does not make a difference, even though it looks like it's bullish or the other one looks like it's bearish. It doesn't matter because the open and close price are so close together. So in this bullish looking candle here, this is the open price moved up. Here, this is the close price. However, the body is so close or so small that it does not really matter whether you call it a bullish spinning top or not. They are neutral. They're neutral candlesticks. So in the spinning tops, we have open price, close price. At one point, price was all the way to the top, and at another point, price was all the way to the bottom. So this gives us a very interesting candlestick formation where you have long wicks but a very small body. So think of when when we were all kids, we used to play with those spinning tops. That's exactly what they are. They have small bodies and long wicks. Same with this one here as well. You have a small body, price opened high here, closed low here, but at one point this candle was green pushing up into the highs, and at one point the price was all the way down here. However, nobody is in control. The buyers weren't able to push the price high. The sellers weren't able to push the price low. So in the middle, this is a very neutral candle. So the most important things about these are that we have long wicks and small bodies. And the pattern represents indecision in the market. It just shows that whatever the previous trend was. So if it was an uptrend, and that means the trend could now potentially reverse because we don't have enough buyers left in the market to push the price higher. And if the previous trend was a downtrend, it means we could potentially see a reversal of the trend now because we don't have enough sellers left in the market. So when you see these spinning tops, just know that we may have a condition where market could potentially reverse. Now, I use the word potentially, and the reason I do that is it's not necessary that it will reverse, but it could reverse. Sometimes you'll get these spinning tops during consolidation periods. So during those periods, the price may not return. So when you see spinning tops, I don't recommend just taking a trade right then and there. When you see spinning tops, just know that we could see a potential reversal in the market. So if you're in a trade, you may want to bring your take profit, or you may want to remove your trade, or you may want to bring your stop loss closer so that you are protecting your trade. And if you see them in terms of, if you're not in a trade and you're looking to enter a trade, this will be that early indication that your entry may be, coming up close. So that's how we can use these candles to actually, one, to manage our trade. If you're in a trade, this may show that it may be time to get out. Or if you're not in a trade, if you're looking to get into a trade, then these will show that we may have a trade fairly soon. So it just gives you that early warning to get prepared to enter a trade. So those are spinning tops, and when we go to the charts, we will see those. So guys, if somebody's turning their videos on, you may want to turn it off. All right, so next one that we'll take a look at will be Marubozus. So whereas the spinning tops were candles that had long wicks, Marubozus are very different. They're almost the opposite of that. So these are the candles that actually don't have any wicks. These are very, very strong candles. And what the Marubozu looks like is in the white Marubozu or a bullish Marubozu, you'll have a price that starts at the bottom, that opens at the bottom, and then the candle closes at the very, very high of that particular candle. So you will not see any wicks in these candles. And the important thing to note here is because there are no wicks, the lack of wicks indicates that these candles are very strong candles. In the bullish Marubozu, when the price opens low and closes high, it means that the buyers were completely in charge. There were no sellers or no selling pressure in that candle. What that represents is that we may see the price go up now. So this is a very bullish candle that generally sets up before the price starts to move up. So that's the white Marubozu or bullish Marubozu. And then we have bearish or black Marubozu. So if your charts look, if you have green and red candles, this will be the green one and this will be the red one. So you have the price that opened here and price closed at the very, very bottom of the candle. So that generally what happens after this candle, you'll see the price drop. So this is again a very bearish candle. This shows that there were no buyers in the market. It was the sellers were in control the entire time the candle was being formed. So this is a very strong continuation pattern. We would expect the price to then drop from here. So anytime you see these Marubozu set up at key support and resistance areas, you know that we may see the price continuation. So where spinning tops are indecision candles and they show that we may potentially see a reversal in the market, these are, oh, excuse me. These are continuation candlesticks where they will show that price will now continue in the direction that the candle is formed in. And we'll go to the charts and take a look at those as well in a bit. The next one we'll take a look at will be a hammer. A hammer is a bullish reversal pattern, and this is formed at bottom of the downtrend. So when the price is coming down, so you will see price generally, let's draw it out here. So we'll have price coming down like this, and at the bottom you will get one of these candles. So something that looks like this with the small body up here. And that generally means that the price is now, the trend may be coming to an end, and we will likely see one of these. So they are very, very strong reversal candles. And another name for these, so hammers and shooting stars can be grouped together into what's called pin bars. Pin bars are very, very strong reversal patterns, and I love trading pin bars, especially on a 1-hour chart. So let's take a look at this candle. This is, so like I said, this is a bullish reversal pattern. So price opened here and closed at the top of this candle. And then we have a long, really, really long wick, which is usually about 2 to 3 times the body here. So when we see hammers form, it shows that the sellers were trying to push the price to the downside. However, they did not have enough strength. So we have price getting pushed back up to the high. And not only were the buyers able to push the price to the open, they were able to go past the open price and get into and close higher than the open price. So this is a very bullish signal, shows that the buyers have come into the market and now they may have the upper hand. So generally at the very top, we'll have either a short wick or we may not have a wick at all. Okay, so let's get into some charts now. So we'll start from the top. Let's start by taking a look at the spinning tops. So we're kind of halfway through looking at the pattern. So we'll look at some examples and then we'll continue on. Any questions so far? about any of the patterns that we have discussed? Okay, so let's move on to the chart. So we are going to look for spinning tops. Okay, we will look at the pin bar. I will answer that question once we get to the pin. There was a question about the pin bars, so I will answer that in just a bit here. Okay, so first thing we'll take a look at will be the spinning top. Let's see if we can find a few examples of spinning tops here. Spinning tops, a lot of the times you'll find spinning tops either in consolidation or when you have a trend at the bottom of the trend. So you'll have, or in the middle where price comes down, gives you a spinning top, and then you'll see the price either reverse or hesitate before it continues on. So I am going to look for some spinning tops here so I can give you some examples. So here, these are not, these are not charts. I've marked up some trades, some good ones that I really want to show you, but I wanted to give you some live examples. So we're looking at real charts here under normal market conditions. So these are not charts that are, that I have marked up just to show those particular patterns. So we're looking at live charts here. So here is an example of spinning top. See right here, this is our spinning top. So let me insert. So this is the candle that I'm looking at. See this red candle here? So we have price coming down, and then we get this red candle here. So we have in the candle here, we have a very small body. We have long wick to the bottom, long wick on the top, and the body is right in the middle. So the wicks are approximately the same size. So that's an example of a spinning top. And then let's take a look at this candle in the middle here. It has long wicks on both sides and then a very small body. So that's another example of a spinning top. Normally, like I said, you will tend to see them at support and resistance area. So if you can see here, there's support and resistance area coming from this right over here. And they tend to form at strong support and resistance areas, or just any, when you see these, prices tend to generally, churn. So here we have price drops, goes back and tests it, and then drops again. So here we can see a spinning top. Also, here's another spinning top. So we have long wick on the upside, long wick to the downside, and a very small body in the middle. So that's another example. So under live market conditions, they can look quite different. So that's why I wanted to show you what they look like on real charts here. So here's another one. If you see this green one here, we have long wick up top, long wick in the bottom, and then we have this body in the middle. And as you can see, most of the place, so we don't see them when the trend is, on. We don't see them doing a strong trend. We only see them when there's a hesitation or when the market is about to reverse. So when you see a hesitation, let's say you see a strong trend and you see price hesitating like that, chances are very soon the price may reverse. So that's why they are good indecision candles. They show us that we don't have any one party winning the war at this point. We have sellers who are trying to push the price down, buyers trying to push the price up. So we get these candles that are have no strength in them, basically. So they're very neutral. Price goes up, price goes down, closes in the middle. So you tend to see a lot of them when the market is about to reverse. So here's another one. Here's another one. So when you look for, I would recommend go look at your charts and see where you find these candles, and the points that you will generally find them will be when the price is turning. So pick a top or a bottom, and you can see some spinning tops there. So that's our indecision candle. Any question about the spinning top? So here's another one. We have, and they can have green bodies or red bodies. It doesn't really matter because either way they are indecisions. The green body doesn't mean that the price will go higher. It just means there's indecision in the market and the market hasn't decided which way it's going to go. So here's a green one, here's a red one, long wicks and small bodies. So let's go on to the next one. I don't see any questions come through, so we'll move on to the next one. Yes, so spinning tops, the question is, do the spinning tops mean more when they are on higher time frames? And that's correct. So higher the time frame of your chart. So if you're looking at, let's say, an hourly chart and you get a spinning top, it will have, it'll be more meaningful than on a 5-minute chart. So higher the time frame, the better the signal. So yes, that's true for spinning tops as well. Yeah, so 1 hour will have a stronger signal than a 5-minute. Okay, so those were the spinning tops. Now let's take a look at Marubozus. Marubozus, again, they are very, very strong candles. So spinning tops were weak candles. Marubozus are very, very strong candles. If we have a white Marubozu or a bullish Marubozu, that means buyers are in charge and then we can see the price pushed up. And when we have a black Marubozu, that means that sellers are in charge and we are likely to see price continuing to the downside. So let's go take a look at that. Marubozus are generally harder to find because they don't look exactly the same in on the charts as they do in when we draw them out. But this is one example here. This is a very close example. And this is something to realize when you are actually trading. So trading is a science and an art. We have candlesticks that are perfect when we learn about them, but when you actually go to your charts, they may not look exactly perfect the way we see them on our in our drawings. So bear with me on that. In terms of the in terms of the Marubozu, this is a bearish Marubozu. As you can see, the price opened here, closed here, and there was no wick on the downside. Normally, you don't want to see a wick on the upside either, but you don't see them on the bottom. The question here is, what are the dotted lines here? Actually, it's a pivot point indicator. If you guys follow me, you will see I do use pivot point indicators. So I'll just remove them just so it doesn't distract us. It's just a pivot point indicator, and you can generally find it in your pivot point in your indicators here. So this is a bearish Marubozu. We have price open here, close down here, no wick at the bottom. We especially don't want to see a wick at the bottom, and a very, very tiny wick at the top. So this is a very strong bearish candle. And we generally see them at the start of a trend. So generally when we have a candle that looks like this, see how the other candles are so small, and then we have a very definite kind of candle, very strong candle that shows us the price will start to move down, and then the price does. So these signal the beginning of a trend, whereas the spinning tops signal potential end of a trend. The Marubozus are usually continuation candles, so they are found when the trend is going to continue or when the trend starts. So that's our bearish Marubozu right over here. And then let's see if we can find some more. So one of the things that I suggest in terms of getting really comfortable with these things would be to go do your homework. What I mean by homework is this is what I'm doing here. So we go backwards on the charts and we look for those trade patterns or those chart patterns, because the more you can see the price that showed up in the past, the more you'll be able to see them see that in the real live markets. So this is the exercise, and this is one of the reasons I wanted to do this today, was show you how I go back on the charts and I mark my charts up. So make sure you do that too, because the more you do that, the more you mark up your charts and draw your patterns on the charts, the more you'll be able to see them when the markets are actually moving. So here is an example of a bullish Marubozu. It's not a perfect example. Here's another one. It's not a perfect example, but what you're looking for is a price that opens right here, closes at the very, very top of the candle. So when the price opens in one direction and just closes there without a large pin, it means that the other party is not in control. So when it's a bullish candle, it's the buyers that are in control, and we don't see any sellers, are nowhere to be found. So this generally means that the price is likely to go up. So we have candles that, as you can see, the price goes up from here. We have, this is a Marubozu here as well, and this is now getting to the next step. So when you see a strong Marubozu here, or any kind of a candle, so here we have spinning tops market. This shows indecision in the market. We have buyers coming in, indecision, seller coming in, very neutral market, and then market starts to go sideways, and as you can see, it starts to go higher. It's getting higher now. If you draw a trend line, price is trying to go up. So this is your bullish Marubozu here, and then from here on, price starts to continue. So that's our bullish Marubozu. Here's a bearish Marubozu again. Price opens at the top, closes at the bottom. There's really no buyers in charge here, and then we get follow through, as you can see, and this was the news. Any questions in terms of bullish and bearish Marubozus? My charts are in the UK time zone. However, in terms of the chart, instead of the candles will be formed in all time zones, because the candles will be the candles. So the main difference that we find between US, UK sessions and Asian sessions is that Asian sessions, the range will be very, very small. So whereas, let's say, pound can move 200 pips between European and US session, it may only move 50 pips in the Asian session. So when you're trading the Asian session, the candlesticks will look the same. However, they may be smaller in size, because there really isn't that much price movement. So there's more volatility in the US and European sessions, which makes the candlesticks will be nice and long like this. Whereas if you're trading an Asian session, you may get small candlesticks, and you may also get more of the spinning tops and pin bars like this. So that's the main difference. The size of the candlesticks tends to be different between Asian and the UK and US sessions. Okay, so let's go back to our charts now. Yes, my charts are in GMT. Let's go back to the chart. So we looked at spinning tops, we looked at Marubozus. Next, let's take a look at the hammers. Hammers are hammers, also known as pin bars, are one of my favorite ones to trade. So just a quick review here. In a hammer, which is a bullish reversal pattern, we see it's generally formed at the bottom of a downtrend. So normally you will see price will be coming down like this. You have price going down, and then you see one of these. And generally what tends to happen is this. We get price, it hammers out a bottom, and then price will start to move up. So we have a large wick, which is 2 to 3 times the body, and price closes up higher than the open price, which represents that the market is likely to start going back up. And buyers have come in charge here instead of the sellers who were pushing the price down before. So normally we see this at the bottom of a trend, and very, very nice candles to trade. So here we have an example, like we also call these pin bars. So this is an example of a bullish pin bar or a hammer. So price was going down before and then pulled back up, pulled back down again, and we have this support and resistance area here, and we see a nice, and this is a New Zealand US dollar 1 hour chart. So price goes into this level and pushes off of that. So this is this signal represents that the market will start going up now. And if you look at these three candlesticks, it's a pattern called Morning Star, which is also a reversal pattern, bullish reversal pattern. However, just aside from these other two candles, we can see this candle itself is a strong signal to go up. So when you see pin bars or hammers on 1 hour chart, I like to trade them off of the 1 hour chart. Those are my favorite, or this is my favorite candlestick pattern to trade from a 1 hour chart. And if you see them on a daily chart, they're even stronger because the higher the time frame we go into, the signals tend to get stronger. However, I have personally found them to work best for 1 hour charts. So here price tries to push down. There's a support and resistance area here, and then gets pushed back up. And now we have price going up in instead of this. So this is just a pullback, and price continues up. So that's your pin bar or a hammer. And the reversal or the opposite of this is a shooting star. So this is an example of a shooting star. Up here we see price pushes up. So this is an uptrend now, and then price comes to a support and resistance level, and then we start to see pins here. See how we have a long wick on top and then a small body, which is a red body, small red body and a large pin. And the pin is at least 2 to 3 times the size of the body here. This here is a bearish reversal signal, and we can see price drops from there. We see another pin bar here, and as you can see from there on, price drops. So this is what the pin bars represent. So when the pin bar is at the top with the red body and a long wick to the upside, that is called a shooting star. So think of the shooting stars in the sky. So you have a long tail and a small body. That's what it means. And then a hammer would be like your hammer that we use in our construction projects or projects around the house. So think of it like that. So the hammer has a long stick at the bottom, the long wick, and then you have a small body. And hammers are bullish signals. Shooting stars are bearish signals. So this is our shooting star. This is what it looks like. We have a long body. So at one point, price was getting pushed up. Then buyers were in charge, and then sellers came in the market and started to push the price down. As we can see, price closed below the open. So there is strength. Sellers have a lot of strength here. Buyers are getting weaker. So we may now see the price go down. So hammers, like I said, hammers and shooting stars are very nice signals. Here is another example. Again, I combine both the hammers and shooting stars into a strategy called pin bar trade strategy. So basically, if you do a search for pin bars, you will see that it's a candle with it will be either a shooting star or a hammer. So both are called pin bars because they look like a pin. So you have a long body and long wick and a small body. So here, the first thing that you want to do is look for these patterns at key support and resistance area. If you get them on a 5-minute chart in the middle of nowhere, I would not trade them just because they are weak. A market could just be consolidating or going sideways. So they don't really give us any information on a 1-minute chart or a 5-minute chart. They just mean that over the next little while, we may not have a strong trend, which is not good, which doesn't really tell us much. but on something like a 1 hour chart, you get them on a key support and resistance area. Here this is a key support and resistance area. We see a pin bar, market was going up. So shooting star here is a reversal, is a bearish reversal signal. So we see that the price was going up, and then we got this nice pin bar at a key support and resistance area here. And then from there on, price dropped, another shooting star here, and then price drops further. So this is a good example of what a shooting star would look like. So the best confirmation really is that it will be at a key support and resistance area. So that's what you're looking for. If it's in the middle, it doesn't matter. If it's at a key, so first thing, so how do you take a trade in this? Let's take a look. Let's talk about that. So first thing I would do is I would go and mark my support and resistance area. So you can mark that on your daily chart, on a 4-hour chart, 1 hour chart. Mark your support and key support and resistance area where price has reacted previously. So once you mark those, and as the price is going about, you look for the reversal pattern. See if you get a shooting star at a key reversal or a key support and resistance area. And also if it's on a 1 hour chart or a 4-hour chart, that's very strong indication that the market has run out of steam. So if it's on a 4-hour chart, it just means that for 4 hours the price wasn't able to go through that level. And in this chart, this is a 1 hour chart. So if you take a look here, so for 1, 2, 3, 4, 5 hours, buyers tried to push the price through this key support and resistance area, but they failed. So that means that the price is likely to start coming down now, and we see that. However, if you get this at, let's say, 5 p.m. Eastern or 6 p.m. Eastern, which is the gap time between your US and Asian session, just ignore those signals because market will tend to go sideways during those times. So generally what you will see is during those times, market will kind of tend to do this. So it's just going sideways, not really going anywhere. So we are not looking for these kind of consolidating market conditions for these signals. We are looking for a shooting star, we need to see an uptrend in place. If you see an uptrend in place and at a key support and resistance area, you see this shooting star form, that gives us an indication that the market is likely to reverse now. However, if it's in the middle of the consolidation, so here we have a consolidation here. See, so the price is just moving between these two levels here. So price is moving between this level and this level in the bottom. So if you have a consolidation area and then we have a pin bar up top, so really what does this pin bar tell us? That the price is going to come down, and it does, right? However, it only comes to the bottom of the consolidation. So we would have been able to make a profit in that for sure. However, the profit is very small compared to when you get a signal, let's say, in the middle of US trading session, like 2 p.m., it's at a key level and you get the signal that will generally indicate that the price may come down. Just before the Asian session open, not a good signal, because so we need to take market timing into in our decision as well, not just randomly take these. All right, so let's move on to the next one. Bullish and bearish engulfing candles. So we are doing, so we looked at spinning tops, which were neutral candles. Then we looked at Marubozus, which were very strong candles. Then we looked at pin bars, which were reversal candles. And now we're looking at engulfing candles, which are which basically are continuation candlestick patterns. So when you start to see engulfing candles, you will notice that the price will then start to go up. So what do engulfing candles look like? So actually, you know what? I have a nice Let me just pull up a pattern here. Here I have a couple of different charts here that actually, oh, not that one, that are bullish engulfing here that we can look at. So the bullish engulfing candle looks like this. We have a large bullish candle. So price opened here, closed at the top, and it overtakes the small candle to the left of that. So basically, if you were to put this white candle on top of this black candle, this candle will overtake the black candle. So it completely engulfs it. If you were to overlay them, you won't even be able to see the small black candle. The black candle here is a bearish candle, and this is a bullish candle. This on my charts would look like a green, big green candle. So if you have a big green candle that takes out your red candle, that's called bullish engulfing candle. So here we have the open price, we have the close price. So this is a large body. And then you have the pin bars up top there and another wick in the bottom. So this is what it looks like. So that's your bullish engulfing candle. Let's take a look at bearish engulfing here. So we have a small green or white body here, and then we'll see a big bearish candle, which will be a red candle, or black in this instance, which also means, which is also a bearish candle. So if you were to put this candle on top of this one here, it would completely overlap that. So you won't even be able to see the white candle. And that's what this means. You have one candle that is so strong that it takes out the previous candle. And this generally means that the buyers now are not in charge anymore, and we'll see sellers come into the market. So here in this candle, we have the price open here, price closes at the bottom here, and then we have a wick to the top, and we could have a wick in the bottom. But this has a large body. The candle itself has a large body. So let's go back to our slide here. So bullish engulfing candle, which is this one right here, it signals that a strong move up may be coming. So it happens when the bearish candle to the left here is engulfed by the larger bullish candle that is the very next candle. So the second candle basically engulfs the first candle, and it means that the sellers have run out of steam, and now buyers are stepping into the market, and we could see a move to the upside. So bearish engulfing on the other side is the opposite of that. So we'll have a small bullish candle and a large bearish candle. So when you see this, it means that the market is going to reverse, and price will now continue to the downside. So that's why the candle here, the bearish candle, sellers have stepped in, and then the price will now continue to the downside. So this is what we are seeing here. So let's take a look at bullish and bearish engulfing candle examples. Here is one. So we see that the price has been moving up, very nice uptrend here. And then we start to see these, the consolidating market, and price starts to pull back and then does another push to the upside. And here we have, and here we see price is going into a strong support and resistance area, and then we see a red candle here that completely overtakes the green candle to the right, to the left over here. So couple of key things you're looking for when you're looking to take a trade according to this one here. One is that the red candle here. So if it's a bearish engulfing like this one, so the red candle needs to completely cover the green candle. So we cannot have a small red candle like this one that doesn't cover the previous one. So the red candle in bearish engulfing needs to be at least the same size as the green candle on the left of it. So it has to completely overtake it, which means that the sellers have overtaken the buyers in the market, and the price will start to go down. And as we can see, price goes down. Here is another bearish engulfing candle. See, this green candle here is small, and then the this candle, the red candle here, is much larger than the green candle on the left-hand side. So this is a bearish engulfing candle. This is what we would call a bearish engulfing candle. Here's another example. We have a tiny green candle and a large red candle. So this is a bearish engulfing candles as well. So you can have the candle look quite different. It could look like this, where they're approximately the same size. It could look like this, where the green candle is small and red candle is quite large. It can look like this, where the green candle is really, really small and the red candle is large. So what that basically means is that sellers are in control now, and we are likely to see the price come down. See how we have large candle and this green candle doesn't take it out, so that's not an engulfing candle. Here on the right hand side, this one here, we have red candle that's large and bullish candle here that's quite small. So these are all examples of engulfing candles, bearish engulfing candles. Any questions on the bearish engulfing? And we'll take a look at the chart and see if we can find some. There's a question about volume. I use volume on my charts as well. So if you don't use volume, ignore this. It doesn't matter. You can just trade the candlesticks. But volume, basically, when the trend is going up, you want to see increasing volume. When the trend is coming down, you want to see the volume, red volume, increasing. So when you have a bearish engulfing candle, you want to see red volume to go with that. Volumes right here. So these bars are the volume bars. But if you don't trade volume, this is, in this webinar, we're talking about candlesticks. So if you don't use volume, just ignore it. You don't need to use every single indicator out there. You can just trade the candlesticks. So make sure you learn the price action. Indicators are easy to overlay on top, but if you don't know how to drive your car, you're in trouble. You don't want to just give it to Google Drive to drive it for you. You want to be able, you want to know how to drive your own car. So that's what price action is all about, learning how to track the market as opposed to just letting your indicators tell you what to do. So this was bearish engulfing. So let's go to, before we get to tweezer tops and bottom, let's go to the charts and we will do the same thing. So the reason I put this exercise in today was just to give you an example of how you would do this at home. So this is a very, very important step that I tell everybody to. So go home, when you're done with the webinar, go to your charts, go back on your charts and find these candlesticks. So we looked at bearish engulfing already. So now let's take a look at bullish engulfing. So the place you will generally find these will be at those inflection points, turning points in the market. So here is an example of a bullish engulfing candle. We have a small red candle and a large green candle. And as you can see how once this green candle formed, price just moved away from that. And that's generally what we see when these candlesticks are formed, when the bullish candlesticks are formed, when the engulfing candlesticks are formed at key support and resistance area, they show us that the price is now going to move away from that support and resistance area. Here, as you can see, we have small candles, and then a large green candle. This now shows us a shift in the marketplace where we have gone from sellers being in control to buyers are being in control. And as you can see, the candle is very good sized candle and the red candle to the left of that is small. So this is an example of a bullish engulfing candle. This one here is an example of a bullish engulfing candle. So if you take a look at this candle to the left here, it's a good sized red candle, but the green candle overlaps it. If we were to put the green candle on top of the red candle, it will completely overlap it. We won't be able to see the red candle. So this is an engulfing candle. It completely engulfs the previous one, shows us that the price is ready to move up. And as you can see, price moves up from there. This is a bullish engulfing candle. Look how it overlaps this red candle. If you were to put this candle on top of the red candle, you won't be able to see the red candle. So this is another example of a bullish engulfing candle. So bullish engulfing candle are just mean that the price is likely to go up, and we tend to see this. See, here's another example. So you have a red candle here, small red candle, and a large green candle. This generally means that the price will now pull away from this area. See how price has traded here at this level. So this is your support and resistance level here. Let's just move it up here. So this is your support and resistance level. Price came down, hit this level, pushed off, came down, tried hitting, tried going down, and it just couldn't go through, and then price starts to go up. So the shift candle is this one here, the bullish engulfing candle, that very clearly shows that the price is now moving away from that support and resistance area. So if you're at a key, so let's say you have your line drawn here. So let's say you had a support and resistance line drawn here, and you were waiting for an indication that the trade is ready, the trade setup is ready. You would wait for a bullish green candle like this to go long in a trade if you were looking for a long trade. So this shows that the market is shifted now and is likely to go up. Okay, so that was bullish engulfing. So we can find lots of these examples. See how this is a bullish engulfing candle, overtakes this one here, and price starts to move up. This is a bullish engulfing that we already looked at. And then we have a bearish engulfing here, a small one that overlaps the other one, takes it out. This is a large bearish engulfing candle. And then we have, this is another bearish engulfing candle. So any candle that is larger than the previous candle. Oh, this is a Marubozu as well. Actually, this is a very nice example of a Marubozu. See how there's no pin whatsoever on this candle. So price opens here, closes down here, and there's no wick. So there are no buyers in this candle at all. It's just sellers are in charge. So this is an example of a Marubozu as well as an engulfing candle because it overlaps the previous bullish candle that we saw. So those are some of the examples of our bullish and bearish engulfing. This is bearish engulfing. This is bearish engulfing. And then we have, this is bullish engulfing. This is bullish engulfing. This is bullish engulfing, takes out the previous candle. And all that means, bullish engulfing means green candle takes out the red candle to the left of it. Bearish engulfing means the red candle takes out the one to the green candle to the left of it. So those are our bearish and bullish engulfing candles. Okay, so let's move on to the next pattern that we are going to look at. This is the last one we're going to look at, which are tweezer tops and tweezer bottoms. So the tweezer tops and tweezer bottoms look very much like the hammer and shooting star patterns that we looked at before. So the hammer and shooting star were just one candlestick pattern. Now we're looking at two candlesticks coming together to give us a pattern. So in this case, in the tweezer bottoms, we'll see the price coming down, market is coming down, and then we get this candle with a large pin in the bottom. So we get a pin bar, and then you get another candle with a pin in the bottom, and now we have buyers in charge because price opened here and closed higher. So these two together, they look like tweezers, and they represent that twice the price market tried to push the price down, wasn't successful in doing that, and now we're going to see a reversal. So these are a reversal pattern. Tweezer bottoms are formed at the bottom of a downtrend and indicate that the price will now move up, and the opposite of that is tweezer top. So you'll see the price going up, and then you get this candle where you have a long wick up top and small body, and then you get another one, long wick and small body, but this time price opened high and closed low. So the sellers are in charge. Oops. So sellers are in charge here, and now this shows us that the price is likely to continue to the downside. So they are reversal patterns formed at the end of a trend. So tweezer bottom will be formed at the bottom, at the end of a downtrend, and will indicate that the market is likely to go up, whereas tweezer tops will be formed at the top of a trend and indicate that the market will start going down now. So let's take a look at an example of these ones. So here's our here's a nice example right here. So we have price was going up, pulled down, was tried to go up again, and here we see small body, long wick, small body, small body and long wick. See how the price opened here, closed low. So this shows that the sellers are in charge and the market will go down. And from here on, we saw a drop of about 67 pips. So there's enough room in the market to take a trade. So this is our tweezer top. So you have long wicks up top and small bodies, which represent that the price is likely to go down. So those were tweezer tops. And again, if you see these, I like to trade these patterns on like a 1 hour chart, a daily chart, especially on a daily chart. If you see one of these, they're very, very strong. Strong signals that the price is likely to go in the direction opposite of the wicks. Okay, so here's our tweezer bottoms. As you can see, the price was coming down, and then we get this signal here. So you see price, this candle has a long body, long wick, small body, long wick, small body, and then price tends to starts going up after that. So these generally mark the reversal. So sometimes they may push down slightly, but it's not, it's only 23 pips. So it pushed down a little bit, but then overall this downtrend has reversed. So they are generally formed at a reversal point. So they are reversal signals. So that was double tweezer bottoms there. So I'm just trying to see if we can find more tweezer bottoms. This is not a perfect example, but there are 2 pins in the bottom, and the price closes out bullish here. So this is not bad. Doesn't look perfect, but it is a good signal that the market will now start to go up. Let's see if we can find any more tweezer tops and tweezer bottoms before we wrap it up here. So here's your pin bar. So I would suggest going backwards on charts like this. This is a very nice bearish engulfing candle. The more you mark up your charts and look for these patterns, the easier it will be to recognize them. So here's another one. So you have, tweezer bottoms here. So you have long wicks and small bodies. And then as you can see, the price starts to go up. So those are some of the examples. Any questions about this? So the tweezer tops and tweezer bottom, any of the candlestick patterns that we actually look at are strong indications. There's nothing that's definite in the Forex markets, because like a news could come in, a rumor could come into the market and change the direction of where the market is going. So there is absolutely no guarantees in trading, in any kind of trading. Doesn't matter whether you're doing Forex, stocks, or anything else. So these patterns are usually, they're a very strong indication that we may see a reversal, but they're not, absolute guarantees that the reversal will happen, because a news story. So for example, here we have a big pin here. News could come in and totally take this out, and the next candle could go to the moon. So they're just strong indications, not absolute guarantees. All right, so let's go on to our presentation here again. So these will be, I'm going to put them, the webinar is being recorded, and I will put it on YouTube, my YouTube channel, so you can always go there and check it out. All right. So the most important step here, like I said, is to make sure you go back on your chart. So it's one thing for me to show these to you, but what happens, I find with most people, and this used to happen to me when I was new, that it looked perfect, looks great when someone's showing them to you, but when I looked for these things on my charts, or I was in live market conditions, I couldn't find these things, or I would identify them that the market would go in the opposite direction. So the big step here is to make sure you go do this on your chart. So that's why I wanted to show you how I look for these patterns on my charts. So go backwards on your charts and look for these things, because the more you can see them, the more your brain will focus on them, and you will be able to see them in the future. It's kind of like when you buy a new car. I remember when we bought our car, we have an Audi, and I didn't really know that much about it. It's just my husband wanted to buy it, so I thought we'd go check it out. But as soon as we bought that car, the only car I saw on the street was Audis. Like, that's all I could see. So it's because the brain gets focused on the thing that you're looking for, and it becomes it comes into the forefront of your brain, and the brain will then start identifying that. So I won't see other cars on the road now, but if there's an Audi, I will definitely notice it. So the same thing, if you train your brain to look for tweezer bottoms, anytime there's a tweezer bottom, you will notice it. And that's what happens to me now. Pin bars and tweezer tops and tweezer bottoms, I see them anytime there's one to be found on a chart. My brain just hones on to that. So especially on a 1 hour chart, I really like trading those patterns on a 1 hour chart. And I think there was, let's take a quick look here, and we'll wrap it up here in just a couple minutes. There was one on, see this tweezer, they're not perfect tweezer bottoms, but they're top, sorry, but they're very close. And when you see them on a daily chart, this is pound US dollar daily chart, you see that the market moves away, it does drop, and then you excuse me, you have an engulfing candle here, and then the market drops. So on a daily chart, like I said, the higher the time frame, the more important these signals become. So those are important signals, so keep that in mind. The question is, can we have a webinar on a volume? Yeah, there. I do provide. I think I've done one in the past as well, and we'll do one in volume. I will do that. So no worries. Okay, so next thing. So part of the question was, is there a course that you can take to learn more about this? Absolutely. You can, if you wanted to learn more strategies like this, you can join me. You can go to tradingwithvenus.com/forex course, and I talk a lot about candlesticks and chart patterns and different chart patterns and trade setups that I use. So you can come join me in that. And in terms of what do you get out of the course, you will get 8 core video modules where I will take you from the basics of candlesticks on how to identify some of these patterns that we talked about are in the course, plus there are a lot more that we talk about. And then I also show you how to do proper fundamental and technical analysis every morning, so that you're setting yourself up correctly for your trading day. And then we have, I share with you my some of the trading strategies that I have personally found to be profitable. There are tons of different things that you can learn out there, and some of the strategies out there are really good. So it's just a matter of finding something that works for you, something that you can see. So I've taken some of the ones that I can see quite easily, and I've put them into this course. And these are some of the things that I've learned over, thousands of hours of screen time, so they're all included. I also show you my step-by-step trading process. One thing, when I first started trading full-time, I did not know how to start my my day. Everybody, like, people will tell me, oh, here's a chart pattern, but how do I start my day? What's the first thing that I need to do before I get started? Do I just look at my charts and take a trade, or what do I need to do? So I put together a process that I use before I even put a trade on. I go through this process to make sure I'm aware of everything that's going on in the market, and that just sets you up to trade profitably. And then we'll also talk about managing your risk and how to, how much you should be risking on a per trade and how to manage those trades. Some of the things that that make me different are simplicity. I have a knack for taking complex things and simplifying them. And then we also, during the course, I also talk about some of the deliberate practices that you need to go through, just like we talked about going back on the charts and doing your homework. So make sure you do your homework. The more you do it, the easier it will become for you. And actually, to make the homework part easy for everyone, I've started a new podcast where I break down one trade setup a day. It's called 10,000trades.com. You can also go check it out. So if you don't have the time to go backwards on your chart and mark up your charts, you can check out, I do one video a day. It's a quick 5-minute video. You can basically, it will take you through the chart setup, and then it will show you how to trade. So I tell you where the potential entry and exit points would be, how to identify the trade setup, how to get out of it. So that one's all free. 10,000trades.com is the website, and you can subscribe to the podcast on iTunes if you like, or it's also on my YouTube channel, so you can go there. But in terms of the course, the price of the course is $297. Actually, that we made a mistake, so I decided to keep the price at $297 for today or for the next couple of days here over the weekend. The price, $297 was a promotional price, and it had, we have put the price up to $497, so the promotion is no longer available. However, someone did email me this morning and they said, hey, it says $297, but the actual price when you go to pay for it is $497. So we messed up on the page where the price is listed. So I will, we'll just do it for $297 for this webinar, and the next time the price will, it will adjust back to the normal price. So at this point, if you sign up in the next 2-3 days, before we come back, it will be $297. So you're welcome to go do that. I was just offering that promotional price for some time now, and it will go up to $497. It's not a gimmick. It was just a mistake that we made, that we did not adjust the price. So you still have that $297 price. There's a question. Yeah, so there's a question here. I run a London trade room as well, and it looks like okay, so yeah, so the London trade room runs from 3 a.m. Eastern to 6 a.m. Eastern, and you will be able to see me trade live in the live market conditions. I used to trade the London session a lot before I had kids. Then the kids were young, so I didn't do that very much anymore. So I'm going back to trading the London session. I find there's enough volume and volatility in the market that we are able to get some trades. So you can actually, that one is only $1 to try. So you can try it out for 2 weeks for $1, and after that I'm running a killer promotion. It's $47 a month. The actual price on that is $149, but because I'm just starting the trade room and it takes a little while to settle down into it, so the price that I'm offering is $47 a month. And if you sign up for the trade room now during the promotion, it will always be that. So it doesn't matter if the price goes to $149 or down the road. If we increase the price on that, as long as you stay with me, the price will never go up. So it will always be $47. Even if, let's say, you're with me for 5 years, it will still be the same. even when the promotion is done. So regular price on the trade room is $149, but right now it's an introductory promotion for $47 a month. So that's an option as well. And so you'll be receiving a link to log in to when you sign up for the trade room, you'll receive a link to log in. And then you'll see, just like we are here, you will see my screen, I will walk you through the analysis process, and then I will show you where I'm looking for trades, where I get in, and all of that. So that was just a side point. But for the course here, the course is in the trade room. You just get to see the trades that I'm looking at and the trades that I'm taking, whether it's a profitable day for me or not. You'll be able to see that. And I talk a lot about how I'm analyzing the trade, how I'm going to take the trade, and all that sort of stuff. So it's a great learning opportunity. So I always say, don't just come to the trade room so you can make a profit. That's one of the things. But I actually suggest you trade on the demo trade and really understand what I'm looking for in a trade, because these are the things that I cover in the trade room. But for the course, you will get the full gamut. It will be all the different strategies that I do. In the live trading room this week, I've been trading on a demo trade, but yes, I will be trading with live money. So you will get to see me lose money if I have a losing day, and if I have a profitable day, you'll get to see me make a profit as well. So I will be using one of my accounts. I do have, few different accounts based on what I'm trading, but you'll be able to see one of my accounts, and you'll be able to see, real life what it looks like. So yes, it will be live money, but I still recommend trade it in demo so you understand what I'm doing as opposed to just copying something. Okay, so that's the course. As a bonus, you also get 2 one-on-one coaching sessions with me. So one of the problems with a lot of the video courses is that you go through the course and you don't quite get something. So if that's to overcome that challenge, you have 2 one-on-one sessions with me. You can just book an appointment with me or send me an email, and we can set something up. So if there's anything that you don't understand in the course, make a note of that, and I will share the screen with you, and we will have a chat, and I will explain that stuff to you myself. So you have 2 of those sessions. So I would say combine your questions, and I will personally explain those things to you. You also get full 1 month access to the trade room if you sign up for the video course. So that's available to you. And then you also get, there are some, any of the webinars that I do are recorded, and you will get access to those. So you don't have to go searching for them. They will all be there in your members area. So all of that's available. And then you have email and Skype support as well, of course, from me. So that is, that's the course. To sign up for the course, you can go to tradingwithvenus.com/forex course. And as soon as we end the webinar here, I'm going to change the price back to $297. So right now, if you go there, it will, when you try to pay for it, it will say $497. So that was a mistake at mistake at our end, where the landing page shows a price of $297 and the actual price is $497. So I will honor that, and we'll put the price to $297 so that you can sign up for that, and then starting next week we'll just bring it back to normal. All right, so that's it for today. If you have any questions, you can always email me, raman@tradingwithvenus.com, or if you want to buy the course, that's the link for it. A question about, there's an OBV indicator underneath my chart. So the question is, how do you obtain that? It's actually found in MetaTrader, so you don't need to download anything. Let me end here. So if you look at my charts here, you see this indicator OBV. You can just go to insert. You just go to indicators and then go to volume, and you'll see on balance volume. That's what it is. Okay, so that's it for now. Thank you very much for attending. If you have any questions, please feel free to email me, or you can always go to tradingvenus.com. I'll be there. And if you want to sign up for more webinars, go to tradingwithvenus.com/webinars. And I do a webinar every other week. And I may start doing them every week as well. So you're welcome to join me on the webinar. So thanks again. I will see you next time.